What is up, everybody? Steve here. I came across an article, kind of disturbing. It's from CNBC. Basically, let me show it to you guys here, and I'll link it as always. Mortgage refinance demand surged 6% as rates dropped to the lowest level since September. Now, rates got just over 7%, like 7.25. Now they're at like 6.25. And that's not necessarily a great rate considering, where rates were. But for them to, for refis to increase right now because it went down basically a point is pretty telling as to where I think things are going right now. Unfortunately, here's what I predict, here's what I see is going to happen based on history, based on my own experience in the last real estate crash. But basically what people are doing, they're desperate. They're desperate right now. They have a certain amount of equity in their properties. I bet you a lot of these people had really good rates, really good locked in 30-year fixed rates at maybe 2.75, maybe 3.5%. And they see this equity position, and some people are electing to do HELOC loans, which I talked about in other videos, and that's kind of scary in itself too, where people are just depleting the equity. They're taking the equity position out of their property, and they're probably blowing the money, unfortunately. And then with this situation, people are doing they're doing a refi, they're doing a cash out refi at likely a higher rate, because who was waiting around at the time, during the pandemic when mortgage rates were 2.75% or 2.5%, 30-year fixed. At that point in time, everybody was doing refis. That's when everybody saw cheap money on the table. That's when everybody was buying real estate, getting new mortgages. And if they had existing mortgages, everybody was doing refis. And they're refining into a nice 30-year. Some people are going into 15-year fully amortized mortgages, getting primo rates. Now people are doing cash out refis in the 6s. And I bet you they're cash out refining out of a fantastic, a much lower rate because they want to free up the equity that they have, and they're freeing up this money to basically survive. They see this untapped equity that's sitting there, and they need the money. A lot of people need the money right now to survive. People are looking at it like, I'm going to cash out and consolidate debt because they bought a car. Maybe people racked up credit card debt, which we'll talk about in a second as well. And a lot of times in this situation, this is when people are trying to reconsolidate and they're trying to merge all their debt positions together, especially with credit card debt. Credit card debt is the worst kind of debt out there, especially as the Fed continues to increase rates. It's just bad news because the credit card debt, the interest on that is floating. So people have really no control over that. So people are starting to see their credit card debt minimum payment is just astronomically higher. The rates are higher on it, and people are freaking out. So they're looking at their home as an ATM, as a bank, and they're pulling this money out. The problem is, historically, with people pulling out money out and consolidating debt, it's only a temporary fix because they've never learned the lesson. They never learned the lesson of paying the debt off. Everybody's just merging it together, and yeah, they're looking at it like, okay, I gotta pay, I'm getting out of a really primo mortgage and I'm gonna get into a higher mortgage, but I'm getting rid of my credit card debt, I'm getting rid of my car debt, I'm getting rid of this debt and that debt, I'm putting it all into this. But they never learn the lesson of paying off debt. They never learn the hard lesson of, I need to really stop this lavish lifestyle I'm living and spending beyond my means. And they never learn that lesson. Then what happens? Their car's a year old, they see the next new shiny thing. They never cut up their credit cards either. So they have their credit cards, their balances were wiped out because they did the cash out refi in their house, and they're like, man, I got $30,000-$40,000 worth of equity on these on these credit cards, and now I can go back out and spend. So what they do is they rack up the credit card debt again, they go and they buy another new car, and the cycle just repeats until they get to a certain breaking point where they just can't afford things anymore. Then they go delinquent on the first thing is they go delinquent on the credit cards, then car debt, then home debt, and everything else. And it's just the writing is on the wall, unfortunately. One last part of this is what's going to happen. You'll see it. People are going to have additional lines on their credit card. So, you know, maybe they have a $30,000 max out limit and they only have $10,000 of debt on it. They know that they're probably going to go ahead and go delinquent, but before they go delinquent, they have $20,000 that they're going to rack up. So they're going to go and take whatever they can, and they're going to go and buy everything that they can with that remaining $20,000, and then they're going to rack it up, and then those individuals most likely will go into a bankruptcy situation. It's just a bad philosophy of money in general. And you know, this is kind of why I wanted to shed some light on my own personal situation going through the last crash and what I learned from it. And even right now, sacrificing, you know, we saw the writing on the wall in terms of the real estate market just peaked out and ballooned out. Our own primary, you know, I was selling everything, rental properties and everything else. And even our primary residence, which I loved. I saw that there was an opportunity to cash out on that thing, and we cashed out just under $1.2 million. And right now, and I'm going to bring you guys through it here in the next day or so, or maybe after Christmas. We were doing a short-term rental, and you know, this place in Naples, it's nice and everything. I do not want to continue renting. So, you know, we wanted to figure getting into something at a very low cost and probably turn this thing into a rental in the future. But this gets us out of renting in the short term. We'll probably stay in this property for a year. But we went from a $1.2 million beach condo to this property. It's a hurricane damaged condo. Picked it up for $130. Probably put about 45 into it, being all in for $175 for a decent little condo on a golf course. But it's not where I want to live full time. You know, it's not for a long term or whatever the case is. I want to be back on the beach, and but you know, I'm taking risks, calculated risks, and I think it's going to pay off. So anyway, I'm just nervous for a lot of people going through some shit situations, because I know what a lot of people are going through right now, unfortunately. And if you guys are watching this, I know you guys are prepared, because unfortunately one person's demise is going to be another person's success. And it's going to be an opportune time for us to pick up distressed assets. And we're going to continue this journey together. And as always, I appreciate you guys being here with me today. Thanks a lot for being here.